Yes, we are back. Hi, Kathryn. Hi, Yury. Welcome, both of you. So we have another interesting fireside
Thank you.
chat. That's all about family offices into VCF investing, the opportunities and challenges. So we have the speakers, Yury Mitin. He is from Canada, venture partner. Good News Ventures. So I think you will be always giving good news, I guess, right?
Yeah, I hope so. Yeah.
Okay, so he is with 15 years experience as a venture capitalist, investing in startups, building technology businesses, and he has helped fundraise over $200 million in startups VC funds. That's a great figure. So we have Kathryn Wortsman. She is the managing partner, Amplify Capital. She is the managing director and she is managing the Canada's world's on leading impact funds. Amplify Capital focuses on investing businesses using technology to solve massive social and environmental challenges. So over to you. It's a fireside chat. So once you take up the lead, Yuri, and she will follow it up. The topic is about VCF investing. Go ahead, Yuri.
Yeah. Okay. First of all, thank you for the invitation for like such a great conference. I've just been on several panels before. It's like international. It's really good to hear like during the times of long pandemic and working from home. But by the way, I'm from office right now. But what I can see from my perspective, yes, we do like just a short brief about the Good News Ventures. We're a seed fund based in Ontario, Toronto, like invest in seed stage, I would say average check from 300 to 500. And we've done already about 30 investments and right now deploying our third fund and fundraising and deploying the third fund. And while fundraising, I have to speak as an investor relationship, like as a venture partner with a lot of family offices. And what I realized that the family offices have been evaluating for the last 5 or 7 years. Like if you speak to the family office about 5 or 7 years ago, they will definitely go for your LPGP structure. But right now, there could be a fund managers who could know like all the terms in terms of like IRR, DPI, like how much like capital should be deployed, like what is evaluation, what is the best way to source the deals. So the family office in reality in 2021 became really active players as an independent source of capital for the startups. And for us, general partners or venture partners of a fund, it's been harder and harder to take money from the family offices and manage this money and to invest in a pure deal. Like it's what I've seen. So, for instance, a year ago, when you just approached somebody in the family office, they would be really conservative because of the pandemic. And the last year, it was like at the beginning of March, April, there was really, I mean, frightened of any investments, and they say we're going to be sit on a pile of cash and doing nothing. But in the second and third quarter, like it was a dramatic change, and I've seen a lot of family offices deploying directly into the startups. They're going into the virtual demo days of Techstars, 500 startups, Y Combinator, and they're ready to deploy on pre-IPO stage. So, and they've seen the massive like boost of valuations, and they trying to deploy capital not into venture capital funds as a I would say some kind of intermediary between the startup and the capital. They want to go direct. And I will give you like one of the example. Like I was studying at the Berkeley Venture Capital Program like about a quarter ago, and during the studying, I had one of I would say initial requests from a family office, the guy who made like about 200 million of USD, like investing in real estate in stock market. And he said, I want to go and invest in venture capital. And I said, okay, great. So we are the first one. Good news. You should go here. And the second, like Amplify Capital, so definitely should be also. And he said, you know what? I'm seeing some kind of article on Techstars, and I want to go and catch Anderson Horowitz or to catch Sequoia or to go like for some kind of well-known top-tier funds. Because to my mind, I just add somebody from on the LinkedIn and I can go there. And for me, like it was saying that all the family offices right now like, have the transparency to catch like some kind of well-known funds. But the problem is that these funds won't accept them because of they don't know them, they don't need the capital from nobody, and so on. So, and I see right now a big gap between the desire of the First of all, the beneficial owner of a family office. Second, the manager of family office who is just thinking how to make more IRR numbers for the boss. And on the other hand, there is a general partner like the fund managers of venture capital who are trying to catch this money, and this money is not so easy to catch. For instance, like with some family office, we've done a co-investment deal in like this year. It's a Victoria-based like BC, British Columbia startup. They were alumni of Y Combinator in the food tech business. We invest as a fund, and we offered LP to invest in us and then to go into a company. He said, no, I will go directly as a co-investor. I said, all right, we'll give you like SPV, special purpose vehicle. And here we go. So to my mind, there is a huge gap right now, and it's going bigger and bigger because a lot of transparency. Family office want to be a direct investor or LPs in Sequoia. And for venture capital funds, especially for a new one, it's challenging to take the money. And sometimes they say, okay, it's good that you have fund number 3, show the result of fund number 3, and then maybe fund number 4 come back. It is challenging. So this is my first entering point.
That's a good entering point. It's really interesting. So I'm seeing something similar. So we're going into deals early stage. Also, our check size is a little bit bigger, between 500 and 750. Unless it's a really early stage pre-seed deal, then we'll do a $250,000 check. We're seeing where angels are co-investing with us. So angels are really active. They love the game. They love, meeting the founders. It's super exciting. The demo days, it's so accessible, right? Right now, everything's live. So we're seeing a ton of angels go in. Now, unless those angels are, have investment experience, I think for them, it's going to be a learning experience. Investing in startups is not something that you can just pick up overnight. It's easy to go in. It's very hard to come out. Anyone can write a check. That is not hard. Anyone can shake a hand and say, wow, you got a great idea. Let me give you $100,000. But then, managing that capital out is really interesting. We backed away from a deal that was overrun with angels willing to write checks on terms that weren't solid. Like the legals weren't done, that things were like no T's crossed, no I's dotted. It was it was open season. And so we're seeing like it's just a matter of time before some of these angels start learning some big lessons, I think. Also, investors, venture investors like us, we do a lot of homework, right? We dig in on not only the competitive market, we have networks and relationships that these individual investors, and then I'll say, some family offices may or may not have. But, we also dig in on legal terms, and we understand like, well, if we're going to invest in a seed round, how do we get protected in Series A and the Series B? Protected with information rights, pro rata rights, drag along rights, all those things that you really have to start thinking about early if you're going to make your way up through the cap table and then ultimately to an exit. So in our Fund 1, we've invested in multiple rounds, I'm sure you have too, in companies prior to an exit. And because we're an impact fund and Good News Ventures, I think you behave really well. Similarly, we actually protect all the investors that we go in with. So we make sure that we're not cramming down early investors, but that happens all the time. And if a family office or an angel isn't well versed in how private investing works, it can be very easy to get crammed down inadvertently if you don't have a seat at the table, if you don't know what you're doing. So I think there's real value to investing with a Good News Ventures or an Amplify Capital first. Get your feet wet, watch how we do it, read our investment memos, follow us in diligence, follow us how we invest and add value over a few years, and then by all means, co-invest with us or go direct. So we've had a couple family offices and family foundations that did exactly that. So back in 2016, they invested with us and said, okay, we want to watch you, see how you do it. And then and then we'll go do it on our own, which is great, right? That if you can afford it, that's, I think, a good way to do it. They get to ride our coattails and our work, and if the investor has a significant enough position, I'll say, and even, for most of our LPs, they'll often come to me and say, I'm looking at this other deal as a direct, what do you think, right? And I'm sure Good News gets this all the time as well. And we act as advisors. So we'll give, our advice. Maybe we've looked at it. Maybe, it's a deal that we will start to look at. So I think there's real value to be partnering in some way with a venture fund for a family office. So a family office may say, well, I don't want to pay the fees. I can go direct. And the deals are, I have access to all the same deals. Why would I invest in a fund? I think it's really a little bit of watching and learning. And I think overall, just the experience that we have having, like, I've been doing this for 20 years, and Good News, I'm sure, has been doing this for quite a while. So it's just a different lens. Another example is I spoke to a new, I'll call them family office, although they were trying to raise their own VC fund. And he sent me a deal. He said, I'm looking at this health tech deal. What do you think? We're really excited about it. I said, I looked at that deal 5 years ago. They haven't moved an ounce, an inch since I looked at them 5 years ago. It would be a pass on my books because I like to see the team, have traction and significant velocity. But like, that's the sort of thing that you're gonna get if you don't have the experience. It really, again, I can't emphasize enough. It's easy to go in. It's much harder to come out.
Yeah, for true. Like, absolutely, that I've seen, like, from like a big, I would say, energy in the beginning, and then you are making a deep dive, and there are some kind of problems in one of the startups or in a bunch of startups, and you don't know like how to exit. This is the second problem for a family office. That's why I always say to the manager of family office or to the beneficiary owner, I'm just saying, like, okay, you're buying the access, you're buying the expertise. So you buying like an approach how to find the deals. You buying the reputation of the fund manager, yeah. And like in our DNA of our fund, like there are a lot of business angels. Like the managing partners, they've been business angels by themselves for about like 10 years, and they decided to add, like, to create a team, and then to create a team of LPs who will be investing together. But the family offices that I've seen, like even international family offices, for them, like even invest in Canada or US, they are afraid in a bit of like of taxation reasons. But I'm always say, when you go invest in limited partnership, I think like in Amplify Capital, you also have like limited partnership structure. Like they have to pay their own taxes in their own jurisdiction. It's not a big deal like here. They think this could be a challenge if you are like investor in North America. Even in Delaware, if you create an SPV there, you have to pay your taxes on your jurisdiction, whether you're like in the Gulf region, in Eastern Europe, I don't know, maybe in Asia, whatever you like. So that's why these structures are already been created by lawyers, and the fund managers know how to do it. Yeah. The other thing that we also do, like we explain for the family office who just want to be the first time investors in our fund, like, okay, you just join, you can go for a minimum ticket. You can see like how the deals are structured, how many companies do we have in the deal flow, and then you can go and invest with us on follow-on rounds on the previous deals. For instance, you can join like fund number 3 and become a partner in the deals that are growing and they expecting having new capital from fund 2, fund 1. So that's what we do. I think the Amplify Capital also have the same structure when you have like SPV, like special purpose vehicle on exact company for follow-on investments. Yeah.
So we don't actually do the SPVs. I find they only work if it's significant, if it's a significant size, right? And so, to be honest, for our check size is $500,000 to $750,000. So if a family office wants to invest another $500,000, for example, we'll just let them come in directly, and we support them on the legals and diligence and all of that stuff. We kind of give it as a gift, so we don't take fees if they're already an existing LP, right? So if they're already an existing LP and they're writing and they want to go direct, we don't charge a fee and we don't set up an SPV. Now, I'm not going to say I won't do that later if at some point we have a bigger fund and the check sizes do get bigger and the work becomes harder. Or more involved. But for now, if it's just a simple co-invest, I do kind of give that as a gift. And then, the family office feels better, about it. And they feel like they're getting real value for the fees they're paying on their commitment into the fund. And then I also, I'll also do special meetings with larger investors. Say, look, if you're interested in co-investment opportunities in clean tech, for example, we'll have a call once a month. I can go through our pipeline. Maybe, we've looked at some great opportunities that don't fit for the fund, but could really fit for you. So we do that quite a bit as well. So it's kind of like this, it's like a concierge service, right? And so being an LP in the right fund at the right stage, you'll never get that with Sequoia unless you're putting, $500 million into that fund. But for these smaller funds like you and I, you can really tap into a really unique value add and really unique service that you might not get otherwise. So I think it's quite differentiated. It's just a matter of getting the word out there of what we're doing, because I think Canada is an unbelievable place to be investing right now. We're seeing amazing talent, amazing companies. We're seeing our deal flow is exploding compared to what it was in 2016, 2017, 2018. So.
Yeah, I also agree regarding the market. The market is huge. Plus, we have like cross-border investments, like to US. It's also possible to get the companies. But I also thinking like we're here speaking with the family offices and what is their expectations in terms of like reporting. Like we do quarterly reporting, and I know some funds that do day-by-day reporting based on a like investment portal when you can just log in. The same as you see your stocks, you can see the performance of your companies. Like how much reporting do you provide like for your LPs? Because like we do usually quarter basis and some annual call like or annual meeting when we explain what is going on, because we have like dozens of them.
Yeah. That's such a good question. We just had our annual meeting and we put a lot of effort into the annual meeting. We did it over Zoom, of course, and had our new portfolio companies present. And I think that's worthwhile. We also do an annual report, and it's pretty intensive. My team kind of hates me by the end of it, but I think it's really important to do really strong reporting aligned with the LP standards. So there's all these the LPA standards. So we look like $100 million fund based on our reporting, what I've been told. But we're, a $30 million fund. So I think the annual reporting is really important. Quarterly, I do try and send out an email, but it's hard. We're our main job, and this is the challenge that I have with some of the funds that we talk to. Our main job is to source, pick, select, diligence, and invest, and then nurture and exit in the best companies that we possibly can that fit our sectors and expertise. That's our job, right? And so that should really be 75% of our efforts, because that's the value that investors want. And so if we spend any more time than 25% on the reporting, and then of course reporting / fundraising, the ratio starts to tip in the wrong way. And so you start spending more time fundraising and reporting, the financial return, like the deal flow and returns start to suffer. So you really need, you really need to strike the right balance, and make sure that the investors that come into your fund are respecting, the actual work that they want. They want the returns, and the reporting should be in line with the size of your fund and what you're doing. So nothing, but at the same time, you're checking with your companies anyway. So setting up a system is probably the best way to go about it. But yeah, so we report, I'll say major reports annually, NAV reporting quarterly, and a quick email quarterly.
Yeah, so the same thing that we do, but I've seen several funds that do use some kind of special investor portals, like investment, special tools that for LPs just you have an access and you could see like some kind of different performance. Another question, what I've been challenged from the LP side, from family office, is regarding the time. Like usually, usual venture capital funds are for 10-year. Like it's a period when you just commit your money and you have to make an investment, and you're expecting the returns maybe in the shorter period, maybe in 5 years. But you have signed LPA, limited partnership agreement, for 10 years. Have you ever seen in your history and the history of your venture capital investments when someone will be said, "I'm done. I want to quit earlier because we do have a secondaries option. What is exit if I need to make it before the 10-year period will expire?" How do you change the negotiation power with your LP who has already obeyed to invest and to pay all the fees? So how do you deal with that? And then later I will explain what we are doing.
Yeah, so we haven't had that yet, but from what I understand, the legal, there's no legal out, unfortunately. So for an LP to say I want out, the fund manager can say no, but a good fund manager will say, let me see what I can do, right? Let me see if I can help you. So first, I think the opportunity goes to the GP to say, do we want to buy this LP out? Because we get to buy them out at a discount. And so depending on, GP has the best insight, if there's an opportunity to buy that LP out that at the GP level, I think that's first. And then second, offering it to the other LPs who wants, family office A's share, they need to get out, we can offer it at a discount. And then thirdly, I think would be external, but it's simply like, a private market transaction where you essentially, and you probably need some approvals from the existing LPs to make it happen as well.
Yeah, so in one fund where I was a venture partner, it was the first fund about 9 years of the vintage. I've been already passed, and there was some kind of cases when several LPs decided to quit, and there was a secondary market for some kind of this investment. And I always tell to family offices, if you want to invest, you have to first of all expect that you couldn't quit for at least 5 years. After 5 years, you could maybe see what was going on, because that's why you have this portfolio management. You couldn't invest all your venture capital allocation into one fund. You should split it between geographically, maybe between stages. And this is what I've seen between family offices and some kind of obstacles. And sometimes I met the real professional family offices who've done more than 20 investments in funds, and what they're doing is just receiving reports and seeing a lot of deals. And they in some how they be becoming from family offices, they're becoming a fund of fund, because they've done too many investments. Have you seen in your career some kind of family offices who are really professional and who maybe can give an advice for those who are just in the beginners, in investments in as LPs in the funds?
You know what? This is what I've learned is every family office is unique. They have a background in real estate or a background in health. They get excited about certain sectors. They get excited about certain geographies or stages, and it's a learning process for them. And the ones that are allocating to multiple funds, they run their own investment committee process, and the diligence, it shows from a diligence perspective, they ask all the right questions. But again, they all have different, because they're investing these assets to essentially pay for something else. And what is that? What we don't know, right? Every family has their own, I want to be able to, give money to a university, or I want to be able to make sure I leave X amount for my children, or, whatever it is, or for the business or whatever. And so without knowing, what their goal is, it's very hard to say, you know, what's the advice to family offices that are just starting out. My best advice is probably find fund managers that you can relate to, that will talk to you, that will pick up the phone. And if you pick up the phone and you want to talk to them, say, I need advice on this, this, and this, and kind of build that relationship with a few fund managers that you can build trust with. Because often I'm reviewing investment memos for other funds. So you know, some of my LPs say, I'm looking at this other fund. What do you think of that other fund? And that's happened to me a few times. Right. And so I'm more than happy to do that, because I'm building the relationship with that family or investor as well. And so I think, you know, and then by watching and learning, by making a few fund investments, they can really understand, I like that strategy, I don't like that strategy, I like this reporting, I don't like this reporting. The other thing I've also been asked is to talk to other, so a large family office out of Montreal asked me to share how we report, so back to reporting, how we report to some of their other fund investments, to their other fund managers. Those fund managers were saying, you know, we can't do the reporting you're asking for, it's too much work. And they said, well, Kathryn Wortsman and Amplify Capital is doing it, you should speak to her. So, you know, I'll do that as well. So they get a nice comparison of what's happening. And then they can also see trends, like, you know, what's happening in health, education, clean tech, you know, whatever it may be, across the different funds and geographies as well. So I think making a few bets, building relationships, trying to really dig in and understand will help them form how to make future fund investments.
Yeah, we do have like similar approach here, and I'm always telling like family offices who are like a little bit new to this sector, like being like in real estate or stocks or I don't know, some kind of major business where they made the source of wealth. I always tell them, come on, guys. Just follow some of the fund managers that you like. Speak to them. Like, it's good that all fund managers answer the phone when they're fundraising, but they're not answering the phone when they're making like deals and maybe a little bit reporting. They could be a little bit busy there. So that's what I've seen. But if you want to see the results, and we're here all about like IRR, like and like the final like multiple X on returns, like always the decision to go like in one deal because they think it was going to be really super cool like deal that will bring them hundreds of percentage of IRR. In the end of the day, it's resulted that it's better to deploy into a fund because you're going to be more diversified, and you're a family office, you're not a gambler.
I totally agree. The diversification is really, really important.
Yeah, because I saw my main, like when it was the blockchain technology, I was like, oh, I'm going to go there. When it was like some kind of hype about like fintech or some kind of food tech, they say, no, I want to go 100% into this sector. In the end, like after 3 years, you see that the fund still delivers like good results in terms of like the growing of assets, net asset value, and even some dividends, and even some cashback already been returned. But in the deal, there's some kind of, I don't know, like blurred perspective of the future. But 3 years ago, it was like super exciting deal. So that's why diversification and to stick to your plan, the strategy is always good if you are like want to be professional family office who will deploy capital into venture capital. And by the way, do you know how many percentage of the wealth going to venture capital and private equity funds, like from family offices? Do you know like this number?
So, you know, I listened to an earlier panel this morning that said family offices are looking for venture capital because the returns in VC have been great. They really are outperform private equity. But most family offices, I understand, they get their feet wet in the later stage and then they start moving into earlier stage, just from a comfort risk perspective. But unless they're an entrepreneurial family, then they'll start the other way.
Yeah, the same. Yeah. Maybe do you have some kind of questions, or maybe from the audience?
Yeah, that'd be great.
Let's look at some questions.
It's time that people don't want to invest. They always want easy gains, but there is none. Yeah, nothing's easy. So that was just an open question. It's like, this is not easy. It's we just completed an exit in Q1. It was not easy. It's a lot of work at the board with the buyer, negotiating the details, the earnout, et cetera, et cetera. It looks fun in the newspapers, and it is fun. I love it. I do love what I do. Like, investing in these early stage, in our case, mission-driven startups is amazing. But it's a lot of work. It's a lot of work, and it is really a professional job that, the best fund managers take it very seriously. We handle other people's money. We take it seriously, but we're investing in, for returns and impact. And that's our full-time job. It's not something we're doing on the side for fun. And so I would say, to family offices, the opportunity is to invest with fund managers like myself and Good News and Yury that treat this as a professional, this is our professional career. This is what we're experienced in. Absolutely, we'll give you opportunities for co-investment to go direct. But this isn't gambling. This is a serious business.
Thank you. Great.
Yeah, so true. And don't read news. Like, when they see news that there is going to be several X on a deal, but it took about 10 years, maybe it results like, I don't know, 5% of IRR. It's not a good deal that you are expecting. So
yeah, the 5-year overnight success, right?
Yeah.
So we got another question on what are the co-investment opportunities. So I think it might be the same with Good News here, but you tell me. So we are making 20 investments, primarily in Canada, some in the US, so up to 20% of our fund is US investments. And with most of our investments, there is some extra room where we can offer allocation to our LPs. So we're investing in rounds from $1.5 to $3 million. Our check size is 500 to 750. Sometimes we'll lead where we'll have kind of advance notice to bring in our LPs. Even if we're not lead, we usually are able to bring in an LP from kind of 25,000 to 250. We make it easy as a value add to our LPs, so you can follow our diligence, our legals. We support you the whole way, but it's your bank account that debit that sends over the capital. So we're investing in clean tech, health, and education, all technology-based companies, seed stage, to solve for major social and environmental challenges of today and tomorrow.
Yeah, so we do have special purpose vehicles for investments for our LPs, and we've done, for instance, this year a deal, and we just post a deal on Angel List. So, and you can go from 25K up to $500,000. So, and it was 4 million round, and we invest 500K, and several investors just jumped through the Angel List, and it was easy to do it because it's everything is automated. You just have to fill out the name of the vehicle, investment vehicle, how you go. There is a 0% management fee. We just say if you get into the deal, we don't take extra something management fee. It's really good. And there's only 20% carry that we post in the deal because we all want to make money on a future exit, and we do believe this company is going to be growing. And there was company not from the third fund that we are just fundraising and deploying from the second fund. So it was a really good opportunity, and we easily fundraised 4 mil round at a good valuation. By the way, it was a safe deal based on a safe transaction. Yeah. So yes, we do have these opportunities. Minimum checks could be from 25 up to unlimited, what you guys want. And you just have to follow us. I don't know. You can follow us on Facebook if you like to, or just text us that we want to please sign up, and we will send you the deals that we have. It's not a problem.
That's great. So even non-LPs in your fund can co-invest with you.
Yes, that was happened. So for instance, I was negotiating one of the LPs to become potential LPs, to become an LP in a fund. But he said, I'm sorry, guys, I have already invested, and I don't know, do you have any good deals? I said, yes, we have good deals. Do you like this company? He said, yes, I do. And I told him, not only for you, but we already created SPV on AngelList, and we just posted there. And it was like system was working like really fast and really easy. Like you just fill out like the forms. You don't have like to send all these NDAs, like data rooms, like everything was automated on AngelList.
I'll check it out. That's good.
Check it out. And we as a fund used like, and AngelList created this SPV and everything, like all the lawyers, we just paid, I don't know, like small fee for legal. And structure is done, and the investors could just put money in. And we are really like generous because we say it's a good deal. We just take only on upside, like 20.
Yeah. One of our deals, we funded a company called Early Bird in Boston, and Early Bird Education, and we raised some capital on AngelList, but we didn't handle it. It was one of our co-investors that did it. So yeah, we should be doing that more often.
Thank you, friends, for the great insights.
Thank you.
Yeah, no problem.
I think what she said, Kathryn, entry is exciting, but exit is very difficult. Not easy. That's right.
You have to wait.
Yes, you have to have. Family offices offer patient capital, so we have to wait. Thank you for the insight. So look forward again. Thank you. Thank you, Kathryn. Thank you, Yury.
Thank you.
Bye-bye.